Hello students, this is Professor Vincent Osaya. Welcome to my class. This is part 5 of chapter 14 presentation. Chapter 14, long-term liabilities. We are still talking about valuation of bonds. At this point in time, we have a very important issue to discuss. Recall, we said that when the market interest rate is higher than the stated interest rate, the bond will be sold at a discount. When the opposite is the case, the bond will be sold at a premium. Now, the question is, what do we do with that discount? We said that that discount is additional expense or additional interest expense. So the example we illustrated earlier was we have $24,000 discount, and we decided to allocate or divide this $24,000 over 20 interest payment period. So when we did that 20 periods, we came up with $1,200. So every 6 months we went up with additional interest expense of $1,200. So that is how we wind up amortizing or getting rid of the $24,000 every 6 months for 20 periods. Now, that is one approach. So we call that approach straight line. So thus far, we have talked about straight line method of amortizing discount or amortizing premium. Now, a better method is the effective interest method. Okay, so we call this effective interest method. We also call it the yield method. Okay, so the effective interest method takes into account the present value or the time value of money. Hence, it is the better approach or the better method. Hence, it is recommended. That is the approach that is recommended, except if the difference or the amount is not material, then we can use the straight line method. So how does the effective interest method work? Look at what we have here. We said it produces a periodic interest expense equal to a constant percentage of the carrying value of the bonds. What does that mean? That means we are going to multiply the carrying value of the bond at the beginning of the period by the effective interest rate. That is how we calculate the interest expense. As you know, the cash interest payment is calculated based on the face value or par value multiplied by the stated interest rate. That is the actual cash interest payment. So the difference between both is the amount that you amortize. So here we have $1,200 every 6 months. But when you use the effective interest method, because the carrying value or the carrying amount changes every interest payment period, the amount that you amortize is not the same across the board like a straight line method. So we are going to go ahead and demonstrate that in a minute. So let's take a look at an example here. So this corporation issued $100,000 of 8% 10 bonds on January 1st, 2014, due on January 1st, 2019, with interest payable each July 1st and January 1st. Investors require an effective interest rate of 10%, so we have to calculate the bond proceed. Again, remember we said that we have to determine the present value of the two future cash flows. Number one, the present value of the principal. In this case, the principal or the par value is $100,000 due in 5 years. Now, when we look at the present value interest factor, we use the effective interest rate. So in this case, the effective interest rate is 10%, all right? And it is also important for us to know here that 10% is for 1 year, but the interest payment is going to be every 6 months. So because of that, we divide 10% by 2, so that will be 5% every 6 months. So we look up the table, 5% instead of 10%, 10 periods, so it's 5 years bond. Nevertheless, because interest is being paid every 6 months, so that's going to be 10 interest period. So we look up the present value interest factor, 5%, 10 periods, and here we are, 0.61319 multiplied by 100,000, that will give us 61,391. Then we calculate the present value of the interest payment every 6 months. Now, in this case, when it comes to interest payment, remember now we use the stated interest rate. In this case, the stated interest rate is 8%. That is for the calculation of the cash interest payment, and here is 4,000. However, when we are looking for the present value interest factor of annuity, because this is going to be $4,000 every 6 months for the next 10 period, we have to use the effective interest rate in determining the present value interest factor of annuity. So in this case, it's 7.72173 multiplied by 4,000, that will give you 30,000. Add this and you come up with 92,000. So the bond is sold at 92,000 and the face value is 100,000. So we have a discount of 7722. So let's take a look at this is the table, the present value table, and here we are, 5%, 10 period is 5 years bond, but because we are paying interest every 6 months, that will be 10 interest payment periods. So 10, 5%, here is the present value interest factor, and that is what we use. So $100,000 multiplied by the factor, that will give you present value of 61,000. Now let's take a look at the semi-annual interest payment of 4,000. Again, how do we calculate the 4,000? It is the stated interest rate multiplied by the par value. However, we use the effective interest rate to determine the present value of the annuity. In this case, it's ordinary annuity. So 10, 5%, 7.7. Do that math, that will give you 30,000. So we add up the two and we come up with 92,278. That is how we came up with the price of the bond. So from the get-go, the price of the bond is 92,278. That means we are giving a discount of 7,722. It's very important for you to calculate. So let's take a look at what happened here. Now, the next 6 months is very important for you to understand this table like the back of your hand, because a lot of questions on your examination and quiz are going to come from this table one way or another. So let's take a look at the first column here, the date. The second column, the cash payment. See, the $4,000 cash payment is the same every 6 months for 10 interest period. All right. Let's take a look at the interest expense. As you can see, the interest expense amount varies because excuse me. Because the discount amortized differs every 6 months, unlike the straight line where the discount amortized was $1,200 across the board, but this time it is different because we are using the effective interest method. You have to excuse me for a minute. Okay, moving along. So let's take a look at the calculation of interest expense. Now, like we said previously, we said that the interest expense for effective interest method is the carrying value of the bond, in this case 9278, multiply by the effective interest rate, in this case 10%. But because we are making payment every 6 months, 6/12 or half. So that will give you 4,614. As you can see, 4,614 is the interest expense is higher than the cash interest payment because the amortization of the discount increases the interest expense. So now, how do we determine the discount amortized? Is the difference between the interest expense of 4,614 and 4,000. So the discount amortized is 614. So catch this. The 614 discount amortized is being added to the carrying amount of the bond. So the carrying amount of the bond originally was 92,000. Add 614, that will give you 92,892. So the carrying amount of the bond went up by the discount amount. Then take a look at so on and so forth. Take a look at the last period, 952. We add 952, which is the amount that we amortized in the last interest payment period, to 99,000. We now come up with $100,000. So at the end of the life of the bond, take a look at what happened here. So here is the balance sheet, asset, liabilities. So the bond payable from the get-go was $100,000. The discount on bond payable from the get-go was 7,722. So the carrying value of the bond, 92,278. So that was at the beginning. The first 6 months, guess what happened? We amortized a portion of the total discount by 614. In other words, we reduced it by 614, and then we now have the carrying value of 926. So the carrying value of the discount of the discount on bond payable is decreased by 614, and by so doing that it went down by 614, then the carrying value went up by 614, and we have 92,892. Then the next 6 months, the discount on bond payable went down again by 645, and the current value went up by 93,537. Of course, as you know, discount on bond payable is a decrease, all right? So, to bond payable. So, discount on bond payable goes down every 6 months by this amount. Then, the last interest period, discount on bond payable becomes 0. Then the carrying value of the bond is 100,000. It's time for us to cut a check for the investor. So again, it is very important that you are comfortable with the with this schedule of bond discount amortization and the schedule of premium amortization as well. So take a look at what happened. On the get-go, we received 92,278, and with debit discount on bond payable for 7,722. Bonds payable is 100,000. Like we indicated, discount on bond payable is a contract account to bond payable. So on day one, our obligation is actually 92,278. Then first payment, interest expense is debited for 4,614. The discount on bond payable went down by by crediting discount on bond payable, we reduce discount on bond payable by that amount, and cash is credited for 4,000. As you can see, the interest expense is higher than the cash payment. Why? Because of the amortization of the discount. The discount is a problem, it's an additional amount that we consider as interest expense that we need to absorb over the life of the bond. Same thing. So that will be the conclusion of part 5 of this presentation.